Joining us now with JPMorgan with his leadership in fixed income is Bob Michele. Why is the bond market so calm? I look at SOFR swaps recovering. I look at the 10-year real yield really coming in a responsible way. Why is the world turned upside down, except it appears bonds?
Before I answer that, Tom, I have a bone to pick with you. As a New Englander, you should know that New Hampshire actually has the highest quality black flies.
They do.
The more temperate climate, the lakes, vacationers and black flies go there by choice.
And now surveillance audible as well.
Yes.
It is widely understood that the black flies of Bowdoin are far vicious than what you see in the burbs of Colby. There's just no question about it. I was once in a car. This is ancient history. I got out of the car. The flies were so bad, we just got back in the car and left. Thank you for that vision of New England, Mr. Michele. Why is there a calm in the market, your world?
Because a couple of things have happened. The first thing that happened is the deleveraging passed through the system. The forcing of levered investors who had swap trades on, who were short Europe, long the US, all these other things got squeezed out of the system. It took yields very high, it steepened the curve, and then it was done. All the false narratives out there were proven to be false. The thought that foreign official institutions were selling treasuries was just nonsense. When you looked at the Fed's custody data, they actually increased their position. And then you had some blinking. You've had a couple Fed officials acknowledge that, yes, they have a dual mandate, and if something happens in the employment market, they'd be poised to step in. And you had the administration coming out saying, hey, you know what, we're open to talks and we're looking to negotiate. All of those things created calm and now have created a reversal in the bond market.
What's the bond market saying about this U.S. economy, Bob? I keep hearing strategists coming, or economists raising their prospects and their odds for a recession. What's the bond market telling you?
The bond market's telling us, watch out. As things stand, if the tariffs go through as they're currently spec'd out, the 90 days passes, and there's only some moderate compromise, the U.S. is going into recession. I think our economist, Mike Ferroli, has made that clear. He's got the back half of this year at minus 0.5% real GDP. When you look at things like TIPS break-evens, they're down below or right around 2%. They're not at the 4% that everyone's talking about where inflation is going to be. The market realizes that a one-time price reset in inflation will kill top-line demand, aggregate final demand, and we'll go barreling into recession, and then all the pricing will fade.
So does that suggest in the fixed income market, I really don't want to take much credit risk here today? I want to stick to the treasury market and clip that coupon?
You can take good quality credit risk. It doesn't, I've heard a lot of people come on and say, no, you've got to be high quality. We're at the top of the capital structure. If you own any equities, then you should be owning the debt of the companies that you own. And a lot of them are below investment grade. The key is to find companies that can actually make it through a period of taxation with higher prices on their input costs and then some loss and demand destruction in their sales. There are a lot of companies in the investment grade space that will be fine. There's no worry there. And the majority of the high yield market, 97+% of it will be fine.
A generous conversation with Bob Michele. We're going to continue here. We'll get the market open with Lisa Mateo and come back with Mr. Michele. Here, lots to talk about. I do want to get to the entire uproar over endowment. Penn hasn't sold their endowment.
No.
They're not an alternative. Bob Michele had a tantrum like years ago and said, we'll get to that here in a moment. In the equity, I asked this question earlier this morning. In the equity market, there seems to be a dichotomy between modest institutional panic and retail buying the dip. Is there the same dichotomy in your world where retail's cool, calm, and collected, and institutions are in an uproar about what to do with their debt at JPMorgan?
Do you know what? It's been pretty balanced in the acceptance of the bond market. In the last week, among all this furor about the end of dollar exceptionalism and sell America, we saw some enormous flows come in from the APAC region into the U.S. bond market and from the Middle East into the U.S. bond market. And it was a balance of wealth management and institutional. When we look across our own JPMorgan Chase spectrum of affiliates and what they're doing, we're seeing steady flows into the bond market, particularly in the municipal bond market, which is left for dead by the side of the road. It's just too cheap.
You didn't mention governments from the APAC region. Are you able to comment on your knowledge or perspective on what governments are doing with full faith and credit American paper?
Well, like the Fed and the Treasury, we're watching the tick data and we're watching the Fed custody data, and we're not seeing that selling. And it's well known that official institutions, governments tend to buy in the 1 to 5 year part of the curve. That's been strong. I don't see the case for them wanting to sell here. One, I don't know where they would go. Every other bond market is too tiny to absorb the flows. And you're in a negotiation stage. To me, that seems to be the option of last resort.
We're in a stage to get the market open. We're going to continue with Bob Michele of JPMorgan here in a moment. First print I see on the screen is green. Here's Lisa Mateo.
That is good, because that means we're going to continue that momentum from 3 days of gains. Let's see right now. So we'll start with the S&P 500. We do see green. It's on a little change right now, up about 4 points. We have the Dow down about 0.1%, 54 points. The NASDAQ, though, up about 0.1%, 18 points. So a mixed picture to start the day right now. We go to the 2-year yield, 3.79%. That's little change. And the yield on the 10-year, 4.27%. That's down about 4 basis points. To commodities, we have COMEX gold down 2%, $3,278 an ounce. Over to oil, Brent crude down 0.6%, $66 a barrel. We go to the Bloomberg dollar spot index, up about 0.3%. And checking in with Bitcoin, up about 1%, just above 94,000. At the open, we're also checking with Alphabet, up about 2.5%, almost 3%. Intel right now down about 9%. That is your Bloomberg opening bell report. Paul and Tom.
Lisa, did you say Intel down 9%?
Down 9%. Not a good start.
Bob, Mike, and I are old enough to remember when it was like one of the 3 solidest companies on planet Earth. Okay, I'm going to go here because I know you're an expert in it. Folks, they did mark to market because that's what you did in the 19th century. And they sat FDR down in 1938 and said, this ain't working out. And we changed measuring everything every day, every Friday, every moment on Wall Street. It went away. And then we brought it back, and we had the same challenges within the banking system. Should we be marking to market private equity and private credit, or did they get a pass in the Bob Michele world?
I think there's a shadow system there that does mark them to market. And I think this is going to be highlighted this year because, as you well know, there are an awful lot of plans who have expenses to pay. Maybe you're a pension fund, you have retiree benefits. Maybe you're an insurance company, you have claims to pay. Maybe you're a university endowment and you've got to run your school and your funding's been pulled. And now you're looking at your portfolio. What was in alts and illiquid seems not to have moved in price, and everything in the public markets at one point was down 5 to 15, 20%. But the only thing you could sell was what was down. I think you're going to see, one, some rebalancing, and two, some calls about greater liquidity in that space.
Paul, this is really important. On radio, you don't see this, but on YouTube, cardinal rule of thumb, when a global Wall Street leader puts their hands up and starts measuring things, that's when you lean forward and really listen. How big's the haircut? Can you estimate for us blended private equity, a given institution? How much? What's the hit going to be? I got a number in my head.
Yeah, the numbers that have been thrown out there are around 15%.
Yes.
But there is an awful lot of capital that's formed that's gone into the secondary space. So I don't think there's going to be anything near that haircut. I think a lot of capital is there, dry powder. It will absorb it. I know in the private credit space, we look for opportunities in secondaries, and it's very competitive.
Bob Michele, of course, head of all of fixed income debt for JPMorgan this morning. I want you to talk, Bob, and certainly every report we've had at Surveillance is liquidity's in order, the plumbing's in order within the American financial system. Where's the leverage, the shadow of leverage out there? It amends every 10, every 15 years. We move to a new leverage. What's the new leverage out there you worry about?
Well, I think where some of the marginal funding has aggregated is clearly in private credit. If you go back to 2007, I don't really recall much in the way of private credit, except if there was some sort of debt exchange or something like that. And today, estimates are about $2 trillion. So it's come from nowhere to something big. When we look at the size of the entire U.S. banking system, the commercial and industrial loan book, Paul, you will be able to educate us on that, what that actually is. It's $3 trillion. So that's $2 trillion in borrowing that might have historically gone to the public high yield market, the broadly syndicated loan market, or to banks. When we look at the public high yield market, it looks very clean. Even in a fairly meaningful recession, think greater than the Feroli minus 0.5% for a couple quarters, something closer to 1%, we can only get default rates up to about 3% in the public high yield market. And we know there will be more pain. We think that gets felt in private credit. Now, it remains to be seen whether that can all be dealt with behind the scenes, but it feels like we're about to approach the long-awaited shakeout there.
Hey, Bob, Tom and I were just talking to Megan Graper earlier this morning. She runs debt capital markets at Barclays. If she called you up today and she had a new issue in the investment grade market, would you buy that? Are you open to that, given all the craziness that's going out there in the world?
Absolutely, 100%.
Nice.
Because,
all right, Megan, pick up the phone.
Because, don't worry, I'm sure they have.
Yes.
Corporate America is going into this in really good shape.
Okay.
Profit margins are very compelling. Actually, consumer balance sheets are in pretty good shape too. So businesses and households can withstand some level of pain on tariffs. And investment grade companies, we're not all that worried about. And generally, these new deals come with a bit of a concession. We have to know what the company is, you know, what their industry looks like, where are they issuing, all the usual credit research things. But yeah, we're buying. The
president, just making comments, these were taped comments, folks, an hour ago on his way to Rome and the funeral of the Pope, gave us presidential statements on negotiations. Everything's wonderful. I think he literally said it's going to be a wealthier nation. Mm-hmm. The rest of America's turned upside down here, worrying about shipping arrivals in Los Angeles and that. If we, almost on a Hayekian basis, if we clear the market, Bob Michele, is it just like it used to be? Do we go to something new here within American Wall Street? Or do we, if we clear all these troubles, do we go back to what we knew? What, Paul, deep into January?
Yes,
I mean,
exactly.
Do we just revert back to what we knew?
So we're in an interesting couple months here. As I was listening to Lisa talk about the bottom of the capital structure, I think they're called equities. I'm not entirely sure.
Shady.
One of those markets was up a couple tenths. I think the NASDAQ, you know, those specious companies. We're in a period of a couple months where we should see good news, where we're in that 90-day delay on tariffs, that pause. You've already had the administration come out and tell us good things. Negotiations are underway. There are paths to compromise. We're working things out. You've got the Federal Reserve out there telling us, yeah, we're keeping an eye on the labor market. And you've got Secretary Bessent out there saying, we've got this. There are a lot of things we can do in the Treasury market. So all of those things are calm, which didn't exist a couple weeks ago. The second thing is it's too early for the hard data to turn. And we fully expect, unless there's a meaningful rollback on the tariff policy as it sits now, then the hard data will turn. But for now, the next couple months, everything looks to be smooth sailing. I think you could retrace all of the sell-off of March, April.
Thank you. I'm glad on a Friday we got to be. I think I can get through the weekend.
I didn't expect to be positive myself.
One final question. I am so honored to ask you this. With Pennsylvania classics, including CLST 0014, Rome and America, we will have a funeral this weekend in Rome. I have stood in Santa Pudenziana Church, 313 AD, built on Roman ruins, and it was literally where the Pope slept before they built 2 or 3 churches before St. Peter's. Link in this thing that we have within the Catholic Church back to biblical times, back to Roman times. How do you perceive the Catholic Church back to what you studied at Pennsylvania?
Well, that's way outside of my level of expertise. I will tell you, I've been to the Vatican a couple of times, and I'm always impressed. And I do see the classics everywhere. I see the Romans laboring away, constructing a city. It's just spectacular.
Bob Michael, thank you so much. What he really is going to say is we're going to get a 58-page annual report letter from the new Pope, just like we get from Mr. Diamond. Mr. Michael is at JPMorgan.